Our lunch sponsor, also affording us this great speaker today from RBC Wealth Management, we have Brad Fisher and his staff. Let's welcome them. And we have our media supporters, KNDU TV, the Tri-City Herald, and Charter Communications. Charter doing the filming today. Let's thank all of those media folks. Good job back there with the camera. Thank you. Without our sponsors, it would not be possible for us to put on this presentation each year, and we really appreciate these great community neighbors stepping up and helping try to make this happen. We're also thankful to be here in the track building, and we're looking forward to the great food that they're serving for us today out of their culinary department here. And now about RBC Wealth Management. It's a division of the Royal Bank of Canada. It's been assisting clients with their investment needs since 1909. Today, the firm is recognized as one of the world's top 10 largest health managers by assets. Locally, the firm's Tri-Cities branch is located in the Spaulding building at the Richland Y. The office opened there in July of 2006 with 5 employees and now employs 13, 9 of which are financial consultants and 4 support staff. The local branch director is Brad Fisher, who is here with us today and is going to introduce our keynote speaker. Brad has served as the branch director and financial advisor for RBC since July of '06. Prior to this position, he was a financial advisor and branch office manager at Piper Jaffray for 21 years. Brad's a native of the Tri-Cities. He's been actively involved in community service in this area and is a former mayor himself and council member of the city of Kennewick. Let's welcome Brad Fisher.
Thank you very much, Fran, and good afternoon. On behalf of all of us at RBC Wealth Management, it's our distinct pleasure to present a very special guest today. Our speaker is Director of Global Investment Strategies for Invesco, where he analyzes global financial and economic trends to determine where investors may have the greatest potential to earn a high return with the least amount of risk. Born in Africa and raised in Europe and Asia, he combines a global perspective with nearly 3 decades of investment experience. He relies on his own proprietary models and a worldwide network of strategists and analysts to distill complex economic issues into actionable investment themes. He joined Invesco in 2010 after its acquisition of Van Kampen Investments, where he served in a similar capacity from 1996 to 2010. He earned a bachelor's degree in finance from Washington University in St. Louis and holds a certified investment strategist and certified investment management analyst designations. In his spare time, he is an avid bike rider, gourmet chef, and is currently focusing on, I hope I get this right, molecular gastronomy. Please welcome Rick Golod. Rick.
Thank you. All righty. So as was mentioned, I'm basically an interpreter of information. I work for a company that manages about $850 billion. We're the 7th or 8th largest asset manager in the US. We're first in Canada. We're second in Europe. If I'm able to make better forecasts on where the market's going in the economy, it's because I have 150 analysts and about 100 junior analysts crunching numbers. So there aren't too many things that we haven't tried to figure out and quantify. And as was mentioned, what I'm trying to do is figure out where I think investors have the highest probability, making the most money, least amount of risk. So I'm trying to take emotion out of the decision-making process. The only thing I'm a little nervous about is I spend 97% of my time with financial advisors. So I'll apologize up front if I use phrases or terms that are unfamiliar to you. But at least you'll get an idea and perhaps an appreciation of the type of information the advisors here at RBC are getting on, certainly on a monthly basis, quarterly conference calls. Maybe they're checking out my website. In fact, you can access me on iTunes if you just Google my name, Rick Golod. So I blog, I tweet, I don't twerk, that's a good thing. Yeah, we'll just move on from that. I don't know what made me say that. But, and so I find that the difference between professional investors and what I would call retail investors is similar to what happens at the blackjack table. If I asked all of you, if I had 18 showing, would I take another card? And I think you'd say no. And then I'd ask you, well, what if I get that feel? And we've all had that from time to time, right? And the answer is no. And yet, how many of you have made investment decisions based on feel as opposed to probabilities? And I would submit probably all of you. It's just human nature. I find that advisors do the same thing. It's very hard to feel optimistic when the market's down 3 or 4 days in a row. I find that's difficult for myself. And what I'm really concerned about is bad news right now sells. You watch the news programs and there's a negative tone to the information, and some of the positive information that's coming out just seems to be absent from that conversation. So my goal today is to see if we can't cut through the noise, give you a better idea of perhaps what changes you should make to your portfolio moving forward if you're an active investor, give you a better sense of what's likely to happen in the economy. And I'm the first to say that there's a lot of conflicting information. When I look at the stock market, I'm reminded by the fact that we've never had a negative year that ends in 5. So there you go. The market's going up this year. And this goes back to 1895. And yet, to just add insult to injury, when the Patriots win the Super Bowl, the last 3 times the market's been down negative 3.8%. So that's the conflicting data that I'm getting now. Some of us need a little bit more than that, right? Including myself. So my big theme right now is follow the dollar. The dollar will tell you a lot about what's going to happen in the economy, what's going to happen in energy prices, and what's going to happen for the stock market. And let me get through compliance, 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 compliance. Okay. First thing that you might want to just keep in mind when you're investing is the fact that money moves markets. If you just look at the countries that have had the most aggressive monetary policy, they've had the best stock market performance. It's really simple. Liquidity trumps fundamentals until it doesn't. And I'm not trying to be cute, but it drives markets higher. And I've said this to so many times to so many people. When did it ever pay to fight the Fed? You know, we've gone through this cycle of quantitative easing. Did that really fix the economy? Well, debatable. Bought us time. But there are people that would debate whether it really fixed the economy. How about the stock market? This has been the 4th best stock market in history. And yet most individuals have missed a good part of it, especially those that were looking at things like earnings and margins and fundamentals, GDP growth. They missed it. How about Japan? Japan's market's doubled in the last 2.5 years. How many of you have participated in that market? Probably very few. It's doubled. Same situation. They did the same thing the U.S., quantitative easing. They just did it 5 times greater. Their view was, well, if a little quantitative easing works, how about a lot? So their injection of liquidity in their marketplace, 5 times more massive than the U.S. relative to the size of their economy, and then they increased it 60% last November. They just upped it another level. Market's already up in yen. It's only up a couple percent this year, but last 52 weeks, since last April, it's up over 20%. And now we have Europe. Just got involved with increasing their central bank's balance sheet. So my question is, if in the past those countries that had the most massive quantitative easing had the best performance, how would you rank them this year? Who's going to have the most aggressive monetary policy? Japan number 1, Europe number 2, US number 3. So don't be surprised if that's the order of stock market performance. Funny thing about a strong dollar, dollar rises, energy prices fall. Correlation, 97%. And you can see it. It's a very, very tight, actually negative correlation. And the dollar is likely to continue to rise. not just because of the balance sheet differences, but the GDP differential, the interest rate differential, as well as the growth differential in GDP, interest rates, and monetary policy. All argues for the dollar to continue to strengthen. And this is in the early stages of a bull market in the US dollar. We are still trading 25% below where the dollar was back in before the tech wreck in 2001, and we're 50% below where we were during the Plaza Accord in 1986. There's a long way to go. What does that mean? Dollar rises, that improves our purchasing power. We're able to buy more things. When the dollar rises, PEs expand. You only have to get two things right on the stock market: earnings and the multiple investors are willing to pay. Everything else is noise. So dollar strengthens, energy prices fall. What does that do to the economic growth? I've read more misinformation on that. It drives me crazy. It doesn't make me right, but let's use sound logic. Every penny decline at the gas pump puts $1.5 billion in consumers' pockets. 1 penny equals $1.5 billion. So already the decline in energy will inject over $200 billion in consumers' pockets over a year's time, and that will add almost 1 percentage point to GDP. And you're telling me the economy is going to slow? Really? The consumer drives 72% of economic growth. Let's put a picture on this statistic. Anybody here in the construction business? I'm just curious. All right, correct me if I'm wrong, but my experience, I live in Annapolis, Maryland. My experience with construction people that are actually doing the manual labor, they spend everything they make. They're not big savers. So 6 months ago, that I'm going to say guy, but it could be a woman, but let's say guy, now has an extra $40 in his pocket because he didn't have to put as much in the tank. I'll give you 3 guesses what he's going to spend it on. You'll get 2 of them right. Anyone want to take a guess? Would any of you say maybe beer? Yeah, and the second thing, more beer? And his birthday's this Saturday, and he loves steak. Is he going to Capitol Grill, or is he going to Outback? He's going to Outback. Is he shopping at Saks Fifth Avenue, or is he going to JCPenney's and Walmart? And he hasn't taken his family on a vacation for 5 years. Where's he going? In the East Coast, they're going to Disneyland in Orlando. How about cruises? Think about what middle class and lower class were. You think they might be gambling now lately at the closest casino? Maybe Vegas? You know where they're going, what restaurants they're going to go to. But now you're looking at consumer confidence, the highest level in 9 years. Consumer sentiment, the highest level in 11 years. And now I've got disposable income growing the best it's grown in 8 years rather. What do people do when their confidence rises and they have more money in their pockets? They spend it. Especially when you haven't seen wage growth in that demographic for 9 years. Lower middle income, their wages have been fairly flat. Their benefits have been rising, but their wage side of it's been very low. So I see an economy just from the strong dollar, weaker energy prices, and energy is likely to stay lower for longer if I look at supply and demand. It used to be when energy fell, you worried about the economy going into a recession. So you have some of those economists go, oh, we're going into a recession. No, we're not. The U.S. doesn't set the price of energy. China does. And China's going to be slowing for a decade, at least another 5 years. That's actually our windfall. They're slowing. Demand for energy is slowing. Every penny decline puts $1.5 billion in pockets. Consumers now will be the key driver, as it has been, but you're seeing a transfer from manufacturing growth to consumption driving the U.S. So yeah, I would think our economy would reaccelerate. Absolutely. Rising energy price. So I've got rising dollar, weak energy. What do price earnings multiples do when energy prices fall? They go higher. What do PE multiples do when the dollar strengthens? It goes higher. Correlation 75%. The best environment for price earnings multiples, that's the multiple you're paying on earnings, is rising dollar, falling commodities, and that's what we have. What's interesting is when earnings grow and when PEs go higher, stocks trade higher the following year, 100% of the time. Not part of the time, all the time. It actually generates the highest returns in history. Conversely, market corrections, because everybody's worried about it going down, average market correction in that environment, 3.9%. You do not get big market corrections when you have a market driven by earnings multiples, multiple expansion. You just don't. Case in point, last 2 times we'd had big drawdowns in their energy, 60% declines in energy, 85 to 87, this says 86. I'll just go to 87 because I know both numbers, but 85 to 87, energy fell 60% and price earnings multiples doubled. Doubled. Market was up 86% in 2 years. 96, 98, what happened? Energy fell 57%, multiples expanded 57%, market was up 89% in 2 years. What was the dollar doing? Rising. What was inflation doing? Falling. Exactly what we have right now. And yet you don't hear anybody talking about how we might have an amazing market this year. It's like, well, now we're losing oil jobs and we're losing oil and gas capex. Yeah, and how big is that? Just look at the data. It's just simple math. Earnings this year is expected to be $124. That's been adjusted down to about $121. So when you read the business journals, you'll see, well, earnings are coming down. All the decline in earnings is just from energy, and they haven't added any of the offsets from that, like the increase in consumer discretionary. All they've done is take energy down with none of the pluses, which tells you what? That analysts are too aggressive on the, or they're too pessimistic on earnings. Here's the rule of thumb. Earnings grow 1% above revenues, and revenues grow 1% above nominal GDP. And nominal GDP is going to grow about 5% this year. That would mean revenues will grow at 6, earnings will grow at 7. They're buying back shares of their own stocks, which actually adds more earnings, $1 to $2 there, looking at $7 to $9 this year. Yes, we have a headwind in strong dollar, hurts overseas sales. We have a negative in declining energy earnings. Energy is only 9% of the S&P index anyway. It's not a big deal. But yeah, it's coming down. But the flip side is you can see the drivers of the economy. You tell me. I've got 4 drivers of the U.S. economy. We're going to cover 3 years of econ. Government spending, corporate spending, consumer spending, and overseas demand. That's what drives the U.S. Government spending has actually been a negative to GDP. The government has actually been reducing expenditures. They've actually taken about 1.5% away from GDP growth from the sequester. That's yesterday's news. Now they're actually contributing positively to GDP growth. So that's a plus. CapEx is corporate spending, and that's where the oil and gas will be a negative. How much? Oil and gas CapEx is only 0.8% of total CapEx, which is only 15%. So the net loss is 1.2% of total GDP, where the consumer drives 72%. They're 60 times more powerful. The numbers just don't work that oil and gas is going to take this economy down. It doesn't work at all. What about jobs? There's been 819,000 jobs added in the oil and gas industry since 2009. And there's been 9.5 million outside that sector. It's not big enough to have a negative impact on the economy. It's minor. But just the decline in interest rates, the increase in margins for corporations will more than offset the negative effect from energy. And then I still have the consumer that's got more money in their pocket with confidence rising. Hasn't been factored into too many people's models. Understand, I am not always bullish. I was negative in 2000. In fact, in 2000, I had a national conference call predicting that NASDAQ would fall 2,000 points. It fell 1,968. I was negative in 2000, 2001, 2002, predicting they'd be negative all 3 years in a row, turned positive the second week in October, 5 days before the market bottomed. I had a national call 2008 in January with a major firm saying, move your clients to a 50% cash position. This recession is going to be deeper and longer than anybody thought. What was my forecast last year at this time? S&P will close at 2060. It closed at 2058. That was 2 points off. I'm not always positive, but I just look at the data, and the data would suggest stronger GDP, stronger market. CapEx spending, jobs, consumer, big plus. Exports. Exports are going to be a negative. There will be a drag. But right now, the United States, 90% of growth in the U.S. is domestically driven. We only get 7% of revenues from Europe and 8% from Asia. It's just not that much. So we're somewhat self-sufficient. Now, if I'm going to invest, I'd rather own companies that derive the bulk of their earnings in the U.S., not from overseas, because those companies will have lower earnings. Here's something that is very hard for a lot of investors to grasp. Economic growth does not determine stock market performance. That's why I get really insulted when someone erroneously says, Rick Golod, the chief economist. I'm not an economist. I'm a strategist. Economists can tell you where the economy is going, but not the market's reaction to it. They're very poor at that. I have to know something about the economy, but economic growth does not determine stock market performance here or in China or in Europe. And that's why a lot of smart people have missed this fourth best bull market, because they keep looking at the economy saying, well, the economy is really lousy, we have lousy job growth and wage growth. There's other drivers. It's very good in providing insight on where to invest in the U.S., which sectors, which asset classes. But if we're going to use odds, you can tell that right now nominal GDP consensus for this year is over 3%. 83% of the time stocks trade higher in that environment. I can tell you, if I just look at Wall Street's asset allocation towards equities, it's at a level where stocks trade higher 97% of the time the following 12 months. You should be bullish right now. Whatever your maximum allocation towards equities is, that's what it should be right now, especially with interest rates falling. And I say falling, interest rates aren't going to get in the way this year, in my opinion. I say falling because it's not about fundamentals. It's about supply and demand. The government's going to issue $630 billion worth of new bonds this year. What's the demand? $800 billion. What happens when you have more demand than supply? Well, prices rise and yields fall. Right now, the 10-year Treasury is 94% correlated to the 10-year German Bund, which today is trading at 34 basis points, or 0.34%. Where does it usually trade? The 10-year Treasury usually trades 25 basis points above the 10-year Bund, which suggests that the 10-year Treasury in the U.S. could go to 0.6%, below 1%, because of supply and demand. It's not about fundamentals. Well, what if the Fed raises rates? It's still about supply and demand. Everybody thinks that when the Fed raises rates, the 2-year Treasury will spike. No, it won't. Nobody's issuing 2-year paper. There's no supply, and there's all this demand globally. Every time the world gets worried, where do they come? They come to the U.S. So, yes, I think at some point rates will drift higher. I actually think the Fed is going to move at the end of June. September at the latest, because that's the appropriate thing to do. It's not about inflation. There is a calculation, it's called the Taylor rate. It's a way to calculate a neutral Fed funds rate. That would be the interest rate that the Fed maintains that doesn't stimulate the economy or restrict growth. Because in about another 30 days, maybe less than that, you're going to see full employment in the U.S. at 5.5%. We're 5.6 right now. We're growing at 3% quarter over quarter. It's not appropriate to have a Fed funds rate of 15 basis points. The neutral rate is 2.32%. That's where it should be. That would be the neutral rate. Anything below that, you're overstimulating the economy. So it's not about raising rates. It's about returning or getting closer to zero or closer to neutral. So it wouldn't surprise me if that happens. Keep one thing in mind. In the past, and when I mean past, since World War II, every time the Fed raised rates, inflation was in the danger zone, in the red zone. Not this time. Don't be surprised. You're going to see the first time in our history the Fed start to move the Fed funds rate higher without inflation being problematic. And that's going to mean, I believe, a different market outcome, different asset class and sector outperformance. And I feel pretty good about that, which means confident, which doesn't make me right, but it just makes me confident. I was asked to show this slide because most firms, if you're buying stocks, you've all heard about asset allocation, which is just another way of saying don't put all your eggs in one basket, right? Just don't buy one thing, you own different things. And we have these very sophisticated models that have been borrowed from Yale and Harvard's pension fund, and I'm very much aware of those models. I consult a number of institutions on how to manage money and banks. But this, to me, is the simplest and the most effective way. See, I'll ask you the question. There's 4 asset classes up here: large growth, large value, small mid-growth, small mid-value. What if you could predict the best performing asset class 80% of the time? Would you use the information to your advantage? Would you put more money in the space if you could be right 80% of the time for the last 35 years? I think the answer would be yes. I'm rounding up. It's actually only 77% of the time, but it's more than any other model I've ever seen. You see, asset class outperformance has moved clockwise for the last 35 years, since 1979. So when large value is the best performing asset class, large growth is the next best performer, and then it goes small growth, and then it goes small value. It stays there 1 to 4, 1 to 5 years. First half of last year, the best performing asset class was large value. And that's consistent with what I see. Value beats growth when interest rates rise 92% of the time. And value beats growth 89% of the time when the economy reaccelerates. And value beats growth 82% of the time when the dollar strengthens, which it's doing. So what happened last year, first half of the year? Rates went higher, energy went higher, CPI, PPI went higher, which is inflation measures, and large value is the best performing asset class. What happened in the third quarter? All rates didn't go up. They went down, didn't they? Well, if 92% of the time value beats growth when rates rise, what do you think happens when they fall? Growth beats value. So guess what the best performing asset class was for the second half of the year and the year overall? Large growth. Yeah, it was pretty easy to see. There's another component to this rotation of outperformance. There is a pattern of underperformance. Whatever quadrant is the best, the diagonal is the worst at the same time. See, you own all 4 asset classes. I don't believe in playing hopscotch with money, but why wouldn't you put more money in the in-style box, less money in the out-of-style box, let the market tell you when to make the shift? And you might say, well, when do I know that? You read my commentary. Because I've spent 15 years developing the metrics that tell me when to make that shift. So guess what the best, so if I said to you last year the best performing asset class was large growth, what do you think the worst performer was? What's the diagonal? Small value, and you were right. That's exactly what happened. You know what the difference was last year? Over 10 percentage points. 1,000, it's actually about 1,200 basis points. In the last 5 years, it's been about a 50% difference. Imagine if you could have capitalized on that, how much more money you would have, compared to just buying a market. It's night and day. This has been working overseas for 15 years, now going on 16. I just don't have data that goes back farther than that. And I don't know what your feeling is about investing overseas. I'm going to skip that chart. All I can tell you is, if you're investing 95% of your money in the US, it's like buying stocks from A to L because you've left off the rest of the alphabet when you consider the investment opportunities outside our borders. And it's going to be hard for you to be in a position to have the highest probability of making the most money with the least amount of risk if you're just looking at opportunities from A to L. Right now, the overseas markets have 95% of the world's population, 77% of the world's GDP, 52% of the world's market cap. And you say, well, I'm conservative. Your advisors at RBC have access to managers that do it on an ultra-conservative basis and a very aggressive basis. That's their challenge, is matching your time horizon, your risk tolerance, and finding a manager that's suitable. That's where they kind of take my information and say, all right, so how does that fit Mr. Jones or Mrs. Smith? All I can tell you is you know more about Japan than you realize. It's got one moving part, that's it. One moving part. 91% correlation between the Nikkei 225, the Japanese stock market, and the yen-dollar exchange rate. Let me simplify it. You wake up in the morning, you notice the yen is down. I want you to roll over to your significant other and go, the Nikkei will be up today, and you'll be right, because that's how it works. Currency weakens, market goes up. Currency strengthens, market goes down, that's it. It's not about population, it's not about earnings, it's not about quality of balance sheet, it's none of that. It is currency weakens, stock market goes higher. Now, what might ensure that the currency continues to weaken? So Japan just increased their quantitative easing 60%. You know what they're doing with the money? They're buying treasuries, which strengthens the dollar and weakens their currency. And they've doubled their allocation towards equities, which is not only good, so they got a constant buyer in their market and ours. One moving part, one risk. Inflation's the only risk. They want a little, not a lot. And right now they only have a little. That's it. You have to hedge the currency. Your advisor knows how to do that. There's investment opportunities out there if you want to participate, but you're likely looking at a market that's in the early stages of a bull market. You know, it hasn't done anything since 1989, really. And Europe, you know more about Europe than you realize. Europe is a replay of the US. It is the same movie with German subtitles, that's all. It'll be a longer movie. It's the same thing. Draghi is copying Greenspan and Yellen and Bernanke, inject liquidity. Does it help the economy? No. It just makes stock markets go higher. What was the Fed trying to do? Fix the banks, fix real estate, fix the consumer. Where is Europe in this equation? They're still fixing the banks. They're still at stage one. They are where we were in 2011. We were worried about a double-dip recession. We were worried about deflation. And that's exactly what I read about in Europe today. Europe is about Germany, who's the father. And he has 3 sons, and one of them is very responsible. Lives within his means, never gone out of line. He bought a used car when he got out of school. He bought a modest apartment. But the other 2 sons, oh boy, they're reckless. They are wild childs. They spent every nickel they had. They bought a brand new car when they got out of school, way too expensive, too nice of a place, and now they've gone back to Dad and say, Dad, I need to borrow some money. That's France and Spain and Italy. Dad, I need to borrow some money. And what does Dad do? This is a teaching moment. And to learn, you have to go through some pain, don't you? Give me your credit cards. I'm cutting up your credit cards. I'm putting you on a budget. You're not going out drinking Friday night. And all of a sudden, Mom, that's Draghi, says, I understand that you want to teach a lesson to France, Spain, and Italy, but now's not the time. It's too weak. You need to let them get back on more solid footing and then teach the lesson. So Germany, I need to just take a step back. And that's what Germany did. Why? Because their economy's been slowing. And what did Draghi do? He just announced it a couple weeks ago. Quantitative easing, $60 billion a month until September of 2016, if not more. I don't know. I think it's pretty straightforward. In the US, stocks went higher. In Japan, it went higher. And guess what Europe is doing this year? It's up over 8% since January 1, and Germany's up over 11%. It was so predictable, and it still has a long way to go. Hedge the currency. Your advisor would know how to do that. You're looking at 100 euro to the dollar in a year and a half, in my opinion. And that should put a smile on your face for any of you who love to go to, like, Positano, for example, as I do. Because your money's going to go a lot farther than it did before. So that's kind of how I see the world. Oh yeah, China, there's always China. China has just overinvested everything. Now I'm going to switch, right? There's China, yeah. Emerging markets are negatively affected by a strong dollar, negatively affected by falling commodities, negatively affected by tighter financial conditions, and all three are in play right now. So it's not an asset class I would overweight. If you're going to invest in emerging markets, then you want the oil importers, not the oil exporters, which means you want Asia, not Latin America. And within Asia, you would actually want the countries that have a higher consumer base, because that's who benefits the most with falling energy prices. So you'd want the Philippines, Indonesia, Malaysia, and India, but not China. China will, not I think will slow, they will slow the next 5 years. Because we've never had a country on the planet where their economy was 48% driven by investment growth. We've never seen that. The highest we've ever seen prior to that was Japan in '89, and they got up to 32%. I say will as if it's a certainty. I don't think it is, but the probability is extremely high. They've already told you and I that they want to get away from investment growth and get to consumer growth. You've heard that. What they didn't tell you is an investment-driven economy in China creates 12 jobs per $1 million of GDP, and consumer growth creates 3 jobs. So they're going from a 12-job model to a 3-job model. What does that do when you have a real estate overhang? It causes problems, potentially. And you can see it. Our consumer confidence, the best in 9 years. What's going on in China? Their consumer confidence is down. Their economy is the weakest it's been since 1990. You can't say U.S. grows, China does great. How much of China's GDP is exports? Would you say 2%? Because that's what it is. Only 2%. Their makeup of GDP has changed in the last 10 years. And I see a lot of people still looking at data from 10 years ago. It doesn't apply today. They will slow. I've got consumer confidence slowing, railroad traffic slowing, business confidence falling, retail sales falling, gambling receipts at Macau falling, electricity usage falling. This all confirms I've got an economy slowing, and that's why China today cut their interest rate 50 basis points to try to help stimulate growth. It just won't be enough because it's not the type of growth they need. They don't need more money supply. They don't need in credit growth to grow faster. It's already 125% of GDP, which, by the way, is really high. So, yeah, I have a few opinions on where I think things are going. I think you're going to find the U.S. is going to be in great shape. I think you're going to find the fact that we're going to be able to export natural gas within 2 years is going to allow the U.S. to regain its global position as the leader of the world. You know, we've fallen a couple of steps if you haven't noticed. And I say this because I believe part of what we're seeing with energy prices is geopolitical motivated. I was asked by a consultant for the Secretary of Defense to come to the Pentagon in November and meet with the director and deputy director of the Net Assessment Office. This is a group that's empowered to determine where does the military need to be 3, 5, 7, 10 years from now. And it's a powerful office. Congress just passed a law that said you cannot eliminate that group, and then they funded it to perpetuity and actually doubled their allocation, the money that they normally get. That's how important this group is. And it was all about, they wanted to ask me some questions on my views on the world, on the economy, the U.S. Well, it was supposed to last an hour. It went 2 hours. Second hour was, let's talk China, let's talk Russia. You know, if you know anything about Russian, Golod is the Russian verb for hunger. My grandparents are from the Ukraine, kind of watching what's going on over there. A little interested. And I said, my comments on Russia, I said, you know, it's interesting. I remember back in the Reagan years that we were going to build this strategic defensive initiative. Remember Star Wars, the satellite program? And there was a lot of pushback in the U.S. And a lot of people didn't realize what Reagan was doing. He was going to get Russia in this spending war, and they didn't have the bank account to keep up. And it was our way of busting the Russian bank that actually ended up leading to the fall or the decline of the Soviet Union. I said, we have a chance to do that again with energy. We just take those prices lower, and we will crush Russia because 85% of their economy is oil and gas receipts. And this 75-year-old director, bushy-haired guy, knows where all the bodies are buried. All I can tell you is there was a smile on his face that said everything I needed to say, like, we're way ahead of you. Yeah, we're already on top of that. And that was all I needed to hear because he didn't say a lot. He was a listener. Perfect for the CIA. But I could tell, and boy, energy is just like a rock. Russia's currency is down 52%. Now think about that. That means everything you were buying, you're paying double for that now. Your net worth just got cut in half. Inflation is 11.4. Wages are down 7.6 since January 1. They're negative. It's crushing their economy. So when you read, oh, Putin has a high consumer backing, well, that was a year ago. That was taken right after the Olympics. They hate him now. So when does oil bottom? Yeah, when Putin pulls out of the Ukraine. Actually, I think oil might have bottomed last week. Good chance of it. We'll see. But there's some, so who did we get? We got our closest friends, the Saudis, to do what? Open up the spigot full bore. And what was the win-win for them? It hurt their closest enemy, which is Iran. Will help remove the marginal producers so they can control the price. So they were all for that. So we are punishing the world's bad boys, aren't we? Russia, Iran, Venezuela. And now what do you think the U.S. is going to do? This is how I want you to vote in the UN. And if you don't vote that way, I'm going to twist your arm and say, then you don't get energy at these reduced contracts that we'll offer you. And we'll say it obviously in a more positive way. Hey, if you vote with us on this action, the sanctions against Iran, we'll give you below market rate energy. That'll help your economy and keep you in power longer. Okay, that's why I'm so excited that the U.S. now is going to be much more powerfully in world events and decisions that are being made at the UN and in the G20 and the G7 and the G3. Yeah, we're back on top. Yay. All right. I'll be more than happy to take a couple of questions that might still be on your mind. I didn't talk about real estate. I didn't talk about gold. I think I can. I used to work for Sam Zell, structure real estate deals for him. If you don't know who Sam is, he sold his REIT in 2006, about 6 months for the top of the market for $34 billion. I think I know a little bit about real estate as well. So any questions on, I don't know, what might be going on in the world? Yes, sir. Yeah, Greece is even the wildest of all the three sons, who never should have been thrown out of the family long ago. So Greece was adopted under false pretenses. They lied about their balance sheet. They're still lying about their balance sheet. They've had a 12% increase in money in circulation, and yet they told everybody, yeah, but our economy decelerated 6% last year. What? That doesn't even match. So the problem with Greece is, this, and you're going to find, nobody pays taxes. They don't. That's all they have to do. They've got this black underground market, and so everybody's complaining about austerity. Like, what are you talking about? You haven't done anything. So what Merkel really needs Greece to do is say you'll do it. Just say it publicly. You don't have to do it, but just say you will. So I can go back to my constituents and say, see, we're not just giving them more money, but Europe's going to give them more money. I don't know what they're going to call it, but the Greeks don't want to be out of the ECB or the Eurozone. Actually, the countries outside of Greece, other than maybe Norway, they don't want Greece to exit either. Because when Greece leaves, if we allow them to leave, if the European Union allows them to leave, then you've got Ireland and Portugal and Italy and Spain lining up. If we renegotiate their debt, see, here's what we did in Greece. We said, all right, you've got too much debt, so we're going to wipe out 60% of it. So now all you have to do is focus on the 40 that's left, and you have to pay that. You know what they did in a year? They borrowed up and they borrowed another 60. They got right back to where they were a year earlier. And they're talking about austerity, which is the biggest joke. What are you talking? You didn't do anything. You continue to spend more than you want. That just shows you how great socialism is. It's awesome. Capitalism works. It's amazing. Yeah, so I think it works out. Already the new leader, whose name I can't pronounce, because if you haven't figured out, I know numbers pretty well. I can't remember anybody's name, ever, except for my wife's, thank goodness. That would be hard, but yeah, that gets worked out. And if it doesn't, Greece is only 2% of the Eurozone, so they don't really matter anyway. Right? Yes, sir. So the question is, maybe oil's bottom. And by the way, oil stocks on a price-to-book basis are the cheapest they've been since 1928. I'll leave it at that. The price may not have bottomed, but I doubt there's a lot of downside in the stocks. I don't look for $100 oil because we're still producing more than demand. But back to your question. My biggest concern is Putin's stubborn. And he's backed into a corner right now, and dangerous people do dangerous things. So even though all my data says you should be overweighting large cap value because they're cyclical stocks that are undervalued, when quantitative easing ends, interest rates tend to fall and volatility rises, and the risk of Russia keeps volatility high. And when volatility rises, investors seek quality. So I'm very comfortable saying you definitely overweight large than small. And then within large caps, just buy quality companies that pay dividends. I can't answer when he pulls out. I just know that he's got a lot of pain right now that he's dealing with. But he doesn't care about the people. Not really, right? He's kind of a thug if you think about it. He's taken, their bonds used to be investment grade 2 years ago. They were just made junk last 30 days. So he's done such damage to their economy. It'll take them years to recover. September 15th of this year is when he just on the down low, right? Okay. Anything else? And I'll 5, 4, 3, 2. Okay. Yes, sir. Interesting question. In the past, energy was always what we call mean reverting. So the price would fall, and it would fall below the break-even point. So the energy producer would just cap the well. That would reduce supply. And then you'd get this equilibrium, so the price would stabilize, and the economy might grow a little bit, demand would outstrip, and then the price would go back up. Fracking kind of changes that, doesn't it? Because that doesn't really have a break-even. You're throwing the water in there, and you're trying to release 4 or 5 different type of distillates, and you hope you walk away with a profit. So it's about financing. If I could get the money, I'm fracking. And so that, and the fact that something else is changing. So normally you would cap the well, except Russia, for instance, has so much debt. With the lower price, they're actually producing more to get the same revenues to pay the debt, and so is Iran, and so is Venezuela. So actually right now in the U.S., we're producing more oil today than we have since 1983, And our stockpiles are the largest since 1982, since they've been keeping records. So we've got all this excess supply. That's why I think it bottomed, only because the sheik, who's been 1,000% right, said last week, yeah, I think we've now found a bottom, and he's been right 100% of the time. And the price has bounced off of that, but we'll see. But the fact is, if China continues to slow for the next 5 years, I know demand continues to slow. It's going to be the second half of the year when we have more energy taken offline, and that's likely where that price is going to stabilize. So yeah, I think we're close. My target was $40 a barrel for Brent crude. It's what I follow because that's what drives gas prices. And I'm glad it's a little higher than that, but it wouldn't surprise me. With a soft patch, it might pull back down a little bit. We'll see. I think the stocks are pretty cheap, though, as I mentioned. Hey, you guys have been a great audience. I'm going to catch another plane tomorrow and go back to the East Coast, and good luck next year in the Super Bowl.
Let's have another round of applause for Rick and also our other speakers this morning. Thank you. Thank you very much. Don't forget, today's PowerPoint presentations are available online at tridec.org. Also, there were some handouts of Rick's presentation here at lunch today. There may still be some in the back of the room. You might take a look. And I want to take a chance to thank our sponsors today. The keynote sponsor, again, is is Cadillac Regional Medical Center. We have RBC Wealth Management, and then the media folks were KNDU TV, the Tri-City Herald, and Charter Communications, again, who's been shooting the video today. Thank you in the back of the room for that. Let's give them all a great round of applause. You know, and I also want to take a moment to thank the Tridec staff who are here with Carl today. We have Kayla, Tracy, Laura, Betty, and Suann. Are they here? Could they stand up? Thank you all for helping out and putting this program on today so successfully. Thank you all for being here. You know, this is one of the better luncheons I've been to for a while, when you go away with a real heavy dose of good news. So let's go out there and just keep growing the economy, all right? Are we all in? Take care. Thanks for coming.